everyone. Hello, everyone, and welcome back to another episode of Sipping Wealth Live. Tonight, I am going to be discussing real estate. Hold on, y'all. Ooh. Let me fix this real quick. Get this fixed. Okay. Okay. All right, we're all good. Hello, everyone. Welcome back to another episode of Sipping Wealth Live, where I bring you news, tips, and tricks on how to wealth up. For those of you tuned in with me, go ahead and make sure that you hit the subscribe button, any notification bell on the YouTube channel Sipping Wealth, so that I can continue to bring y'all more tips and tricks and good stuff, so that you are wealthing up on this journey with me and with each other, as well as making sure that you hit the share button so that your friends, families, followers, loved ones, all that good stuff is getting this wealth of information as well. So tonight I'm going to give you some tips, some tax deductions that you could take on your personal property. That some tips, some deductions that you may have not even thought about, your tax preparer may not even have brought up with you, that you're leaving money on the table, and you could be taking advantage of these deductions to help bring your tax liability down. So I'm going to go over about 20 of them. I'm just going to spit them out. So if y'all have questions while I'm live, make sure that you drop a comment in the comment section, as well as if you are live with me, go ahead and drop a, hey girl, what's up? Say hey to your girl on the live. Just so that, I know you tuned in with me, because it don't really show me if you hear or not. All right, y'all, let's get it cracking. So I'm going to go ahead and, hold on, because I want to make sure. Y'all, my Facebook be acting up sometimes, because sometimes it won't have my stream on public and I have to do it manually. So I want to make sure it's good. Okay. All right, y'all. So let's go. All right. So the first one I want to start with, y'all, I got my beets juice. So I will be drinking my beets juice while I'm talking to y'all tonight. Ooh. It's a little tardy. All right. Okay, so first starters, I'm going to start with the mortgage interest deduction. So at the end of every year, if you have a mortgage on your property, then the interest that you're paying towards that property is deductible. So you can deduct mortgage interest up to $750,000, like of mortgage debt. Okay, and then that's on your first or second home. So this is now the mortgage interest deduction really comes into play if you're itemizing. So some people, if you're not doing an itemized deduction, sometimes you may see that, oh, my numbers didn't change using the mortgage interest deduction. It didn't help bring down my tax bill. Well, it only helps bring down your tax bill if you're doing an itemized deduction generally. Now, if I'm going to show y'all, I'm going to give y'all a different strategy that even if you are not doing an itemized deduction, you can still take advantage of that mortgage interest deduction. But for example, in basic, if somebody's like doing an itemized deduction, meaning they have more qualified deduction, their qualified deductions exceeds or is higher than the standard deduction. So if their filing status is single and the standard deduction is $14,000, they have qualifying deductions, which can include medical expenses, charitable contributions, that mortgage interest deduction, all that. If they put it in a pot and it's more than $14,000, then it's like, okay, we can use that. And also, a lot of the times your W-2 tells you how much money you spent on healthcare during the year. So your employer-sponsored health care, it'll show you a lot of times that, okay, how much money you pay towards health, your health expenses through your W-2 throughout the year, on your premiums. Okay, so medical expenses, your dental expenses, your mortgage interest, you put that in the bucket. If it exceeds that standard deduction, then you can go ahead and use the itemized deduction method. Another thing, if you are married filing separately, if your spouse does itemized deduction, then you have to as well. All right. So mortgage interest deduction, like I said, if you have a mortgage, you should be getting that 1098 from your mortgage company so that you can see exactly how much money and mortgage interest you pay throughout the year. And there's also generally how much money you paid in taxes, insurance, all that good stuff on that form as well. Sometimes it's not. All right. The other way that you can use your mortgage interest deduction is actually if you are, for example, renting a portion of your property to someone, or you're using that portion of your property for business. So if you're like, hey, I rent a room, for example, I rent a room in my home. So that person that I'm renting the room for, I can deduct mortgage interest, that percentage. So saving that room or the space I'm renting to that person is 15% of my home. Then that means 15% of my mortgage interest, 15% of my utilities, 50% of all these home expenses, I can go ahead and deduct because now I'm essentially utilizing my home, generating money through my home. So now I got a business within the house. And that's just by me renting a room in the home. If you have a business, of course, a lot of people may even be know about the home office deduction. So if you use your home office primarily for business, 95% of the time for business, then you could deduct that space as a home office deduction. Take advantage of this, y'all. And there's indirect and direct cost. So that means anything that's directly in that space that was purchased for that space. Maybe I had to redo the flooring. Maybe I had to paint the space, whatever. Any repairs, anything having done, that's dollar for dollar deduction. Now, if I'm deducting like the utilities for the entire property taxes for the entire property, something like that, then I get to deduct that 15 portion of my property based on the square footage of the room versus the square footage of my entire house. Okay, so that's how that works. But this is a huge, great deduction that a lot of homeowners take advantage of. My clients, I push these deductions with them as well. If I ask them, hey, do you have a mortgage interest form? They're like, oh, what is that? Did your bank are you paying a mortgage? Yes. Oh, did your bank send you a form? Did your mortgage company send you a form? Oh, I don't know. I'm not sure. Let's go ahead and log on to see if you have a form from your mortgage company. And a lot of times they're like, oh my gosh, I do. And then we get that form, we plug it in, we take advantage of that deduction. Property tax deduction kind of works the same way as your mortgage interest deduction. All right. If you are renting a room in your or space in your home, or using a space in your home as a home office, then you can actually deduct the portion of your property taxes based on the space you're renting for your in your property, or that home office that you're renting, that space that you're generating money in. Those are deductions that you can take advantage of. Okay, if you're renting the entire property, maybe you're like, hey, I have family in South Florida. They rent a majority of their rooms. You know, South Florida, y'all, you got to get how you live because it's expensive down there. Okay, so in South Florida, everybody's renting a room. If you're not renting a room in South Florida, oh, you balling for real. Because it is expensive to live down there. So, for example, you have where the homeowner actually just lives in one room and they rent out, maybe they have a 4-bedroom house. They will just stay in that one room and they'll rent out all the other 3 bedrooms. So now majority of their home is now rental income. So now you have 60, 55, whatever percent of the home is now a qualified deduction. Now they could deduct that mortgage interest, deduct those property taxes, deduct those mortgage points, deduct repairs, deduct utilities, everything associated with the property. And they're deducting about 50, 60, whatever percentage of it based on all the rooms that they're renting in their home. Y'all, it is very easy to rent a space in your home. And then also if you're utilizing that space for business. If you're like, hey, I want to start a business, yeah, I want to start it in my get started in my home first before I get a brick and mortar. Maybe you're I have a client that does pound cakes. Maybe they're doing the selling pound cakes. That the kitchen, now the kitchen is that part of the time they can deduct a portion of the kitchen expenses and the home expenses because they're making pound cakes in their home. They're using the garage as storage and all this other stuff. So, ooh, I told you I was gonna need to get my. Ooh, okay. They're using all this space as for their business, whether it's storage, whether they're actually having somebody rent it, or they're using it to prepare items to go to be to being sold. Okay. Another credit. It's not a deduction, but it is a credit. Which y'all, we love credits because credits decrease your tax debt dollar for dollar. It's not bringing down your income. So if you are applying for funding or a loan, it's not saying that you made less money. But a credit is saying, hey, because you qualify for this credit, we are going to bring your tax bill down dollar for dollar. Okay, so here you go. This tax bill is ooh, okay. So this this tax credit is the residential energy credit. So this is for those, I have quite a few clients. They actually installed solar panels. So if you installed solar panels, if you have to get a water heater and you're like, you know what? I'm going to do a solar water heater instead, or a geothermal heat pump, any renewable energy system like charging stations. People have charging stations installed in their home, things like that. Any energy efficient, energy star upgrade into your home, solar panel, whatever. This is a residential energy credit. So a huge credit, great, but this credit only gets applied to the tax bill. So if you don't have a tax bill that year, then it's just gonna roll forward into the next year, and it could be used in the next year. Now, if you do have a tax bill, then great, because they will help decrease the tax bill for that particular year. All right. The other is the home improvement loan interest. So if you had to take out a loan for renovations for your home, the interest that you're paying to the bank, you can actually take that deduction. That is a deductible expense. Okay. So that is another thing. I'm going to repeat it again. If you had to take out a loan for renovations to your home, then and that is essentially extending the life of your home. So they said, hey, because you are doing this, we're going to allow you to deduct the interest on that loan that you're using to renovate your home. All right. Huge deduction that gets missed quite a bit as well. Medical home improvements. Now, for this normally gets used for like my older folks or my people that are taking care of their parents, things like that. So if they have to do a upgrade to their home for medical reasons, maybe they have to put in a wheelchair ramp to their home, or they had to do certain updates. Maybe they had to install certain beds or equipments, whatever, into the home. Then you can actually take advantage of a deduction, a medical home improvement deduction. Okay, so you can actually decrease your tax bill based on um, these improvements that you're making to your home for medical reasons. Okay. The other thing is the home sale exclusion. For those of you selling property, maybe you're like, oh, shoot, we want to relocate. We tired of this house. We want to get a bigger house. Or we want to sell our house because it's a great time. And we're just like, whatever reason you have for selling your home. There is the home sale exclusion, which is up to $500,000 and capital gains for married couples and $250,000 for single people. What does that mean? If you purchased the house, oh yeah, Hold on. I need to get my little beach juice again. Ooh. Ooh. Okay. If you purchased a home, oh yeah, I need to drink some water after that. All right. Okay. If you purchased a home say you purchased a home for $300,000, all right. 5 years later, you're like, oh, I want to sell the home, and now the home is actually worth $500,000. Now you still owe. Hey, girl, we're here with you. Hey, how's it going? Thank you for tuning in. Um, yes. So you purchased a home. Oh, you know what? I ain't even got my Yeah, I'm over here to the live. Hold on, I ain't even got my thing on the screen, so y'all know who's talking to y'all. Okay. Let me stop playing, y'all. Okay. Okay. Where am I? Home or sale exclusion. All right. Say you purchased a home in 2020 for $300,000. 5 years later, and it's 2025, and you're ready to sell. Now in 2025, the home is worth $700,000. That means you have $400,000 in gain. Okay, so that $400,000, if you're married, then you don't have to pay taxes on that $400,000 in gain because of this home sale exclusion. Now, if you're single, then only $250,000 of that amount counts towards the exclusion, which means you do have to pay capital gains tax on $150,000 of that money, because now that capital gains that falls out of the home sale exclusion. Okay, now with that $150,000 though, here's the caveat. Okay, now if that $150,000, you can count against it closing costs, getting that property ready to sell. Maybe you had to do some renovations to the property and that cost you $50,000. Maybe you had to pay lawyers and professional services and that cost you $10,000. So now you paid $60,000 just to get that property ready for sale. That brings down that $150,000 that you would have to pay capital gains taxes on, down to $90,000 that you're going to have to pay capital gains tax on. So you do want to make sure that you are counting those deductions when it comes to your capital gains, so that you could bring down that capital gains hit. Okay, anything that happened, anything that you did, that you put into the property to get it ready for sale, can go ahead and bring that a capital gains implication. All right. The other is private mortgage interest deduction. So PMI. I know y'all heard of PMI. If you're a homeowner, you heard of PMI, right? Because sometimes you qualify to not have to pay PMI, but sometimes you have to pay PMI depending on your income level and the amount of money that you're trying to lend for the property. So if your income level is not at a particular marker, and they're like, we will approve you, but you have to have this mortgage insurance, because even though we're approving you for this $500,000 house, we want to make sure we're getting paid at the end of the day. So we're going to require you to take out insurance, which is private mortgage insurance, PMI, to pay us back our money if you end up defaulting. But in that same regard, PMI is a deductible expense as well. Now, if your income is too high, then they're like, look, you made too much money to take this deduction. But so there is a phase out as far as how much. But generally, a lot of people, they're able to take advantage of this PMI deduction. All right, disaster and casualty losses, hurricanes, floods, anything that wasn't covered by insurance, the insurance company. If you had to pay out of pocket for something like huge, um, or maybe you got robbed and they just broke everything in your home, and the insurance company was like, nah, we don't cover all that. And you're like, oh my gosh, what am I gonna do? Even though the IRS is not gonna give you your money back, they'll at least allow you to deduct the unreimbursed damages that happened from the hurricane, flood, whatever happened to the property. Again, that's unreimbursed. So the insurance company couldn't have given you a check for that. But if you do have expenses that came out of pocket, then you can go ahead and take that deduction. Another one is home accessibility tax credit. Once again, y'all, it's a tax credit, and we love our tax credits because it's not going to decrease your income. Girl, what? Which part? Okay. Like I said, so home accessibility tax credit. This again goes for like my elderly or disabled people. So if you had to do home modifications, that's a deduction and a credit. If you had to do home renovations or installations, modifications to your house for a elderly or disabled person, then there is a tax credit for that. Okay. I'm an insurance adjuster and never knew that. Okay, yeah, absolutely. Oh, you're talking about the disaster and casualty losses. Yep. If it's not covered by the insurance company, if you had to come out of pocket for it, you can take that deduction out of your taxes. Yep, that help bring down that tax bill. All right. The next thing is the energy efficient home improvements credit. Once again, this is a tax credit. We love our tax credits. She said, I love it over here. I'm glad you love it, girl. Thank you for tuning in and engaging. Yay, thank you. Okay. Where am I? Energy efficient home improvements. If you make energy efficient home improvements to your house, this is a tax credit. Again, dollar for dollar brings your tax bill down. Now, what does energy efficient improvements look like? Energy Star approved. That's probably like the easiest way to determine if it's an energy efficient improvement. If it says Energy Star on the item, then generally it's gonna be approved. All right. Now, some other things are as well, but you want to make sure you look it up first before you go ahead and purchase it and think that you're going to qualify for the credit, or reach out to your tax professional. Okay. So windows are huge. Windows and doors. I know in South Florida, my mom has to do impact doors, impact windows, impact garage door, all that because of the hurricane. So hurricanes that get down there. So those energy efficient improvements to her home, there's credits. So of course, when I file my mama's taxes, I'm gonna make sure she get them credits. So even though she had to pay out of pocket, she has to pay, to get this stuff installed, which is not gonna give her the installation money back, but it's sure enough gonna make sure her tax bill is lower for that year. So she's not having to pay even more money out of pocket to the IRS, right? On something that she has to do anyway, because in South Florida, you have to have impact doors. The insurance companies don't even want to insure homes that don't have these things. Okay. Or they're going to increase the insurance amount ridiculously because people don't have impact doors or impact windows, things like that. All right, or energy efficient windows. If your window is Energy Star, I know what they do, your roof installation, they have certain roofs that are energy efficient and Energy Star approved, and things like that. You just choose the one that is tax credit. Okay. The other thing, I did mention this already, the rental use. So renting out a portion of your home, so yeah, you can deduct those deduct your home expenses as well. So if you rent out a room in your home, that means, and that room is 15% of your home, then that means 15% of all your expenses in your home. Lawn maintenance, um, utilities, cable, whatever it is deductible. 15% of everything. All right. The other thing is historic preservation credit. So very little people. It's only a specific branch of people that actually get this credit, because your home or something in that about your home um, has to be in the clerk of courts as a preserved structure, historically preserved structure. So if you had like a particular monument or whatever in that property, or you sent out paperwork to the county saying that, hey, we want this to be um, a historic preservation or whatever, then you could go ahead and tap into this credit. But very few people actually go through the work of getting this paperwork done to get this credit, but it exists. So I want to mention it. All right. The other is state and local taxes. This is called a SALT deduction. So, like Salt Bay. All right. So, what a lot of people don't realize is any taxes that you pay to the state and local government, you can actually deduct up to $10,000 of it, dollars of it. That's sales tax. That's anything paid to the Department of Revenue. Let's just keep it up like simple. Anything paid to your county, all that. Now, if you're going to take this, generally you have to like keep all your receipts and things like that, and you're like counting up all the taxes you paid throughout the year, on your receipts and things like that. But it exists, and you can take up to $10,000 in deductions. And this is anything paid, any taxes paid to the state and local government. Okay, y'all. So yes, that is this, up to $10,000. So count up your sales tax. Count up all those taxes that you're paying to the Department of Revenue. Your record, your receipt keeping. On your receipt keeping, the receipt really necessary in a digital world. Yeah. A lot of softwares even allow you to just scan the receipt and they automatically put the data together. So yeah, it does get easier to keep up with your receipts in this digital world, because there's so many different apps that you can use to do it. But yeah. The other thing, interest on home equity loans. Same thing with your renovation loans. It's going to be the same thing with your home equity loans. All the interest that you pay on your home equity loans, you can actually take that deduction as well. Are bank statements not sufficient? No. There are not. They want the receipts. Yeah. What was that? Oh, yeah. So home equity loans, if you pull a home equity loan and you're paying interest on that, you can go ahead and take a deduction for that. And a lot of these are itemized deductions. Moving expense. Now, this is only for my government military employees. So if you have to move because of the armed forces, active duty, military orders, all that good stuff, then you are able to deduct your moving expenses. Lead paint removal. Y'all, they want the lead paint out of your houses. They want to be able to scan and see what y'all doing in your homes. No, I'm playing. No, but seriously, lead paint removal. There is a deduction if you have to go through the renovation of removing lead paint from your homes. Okay. They do not want lead paint in people's houses. Okay. All right, and there is like I said, a deduction for that. And that's, and if I could be specific, the lead paint removal has to be done for like medical reasons because you're having an issue, having lead paint. Foreclosure related deductions. If your home was foreclosed on and you have expenses and things like that due to the foreclosure, then you may be able to take advantage of some deductions as well. All right. This doesn't apply for every deduction that falls under the foreclosure, but it does apply to quite a bit of it. So I recommend going to a knowledgeable tax professional. Your flyby tax professional is not going to know about that, to keep it above. I'm just let y'all know. You're going to have to go somebody more specialized. But it does exist, foreclosure related deductions. So I wanted to make sure I dropped that little knowledge on y'all too. All right, y'all. So that is all. I just went over 20 or so, maybe even more, maybe about 20, 25 different deductions and tax credits that you could take advantage on. And that's your personal property. I wasn't even talking about business. Y'all know I talk about business a lot on the lives. But today was specifically if you have a personal resident, if you're a homeowner and you're like, oh, I want to get my tax bill down. I bought a house and I don't even see the benefit of getting a house. And I want to see how my getting a house can benefit my tax bill. This live was literally for you, created for you. We appreciate you. Thank you. Thank you. I appreciate you tuning in, your feedback and engagement as well. Thank you. This live was specifically for you in mind so that you know, okay, there's a bunch of things that I could take advantage of as a homeowner. So you don't have to go around thinking, dang, I just got a house and it's just a bill. It didn't help me with my tax bill. I'm not able to do this. I'm not able to do that. There's still quite a bit that you're able to take advantage of, even, just by owning a personal resident, not even our investment property. I am still a renter and I found it very knowledgeable. Yes, a lot of these, the mortgage interest and all that other stuff, of course, can apply. But home office deduction, if you're storing anything, if you're using your home for like a portion of your home or closets for storage, if you're renting out a room in the place that you're renting, that still applies. So say you're renting out a unit for $1,200. Let me stop playing because I don't even know where you find the $1,200 rent these days. But say you're renting out a space for $2,400, or you're renting an apartment for $2,400, and you're like, oh, I'm gonna move in Joe, and Joe's gonna pay $900 a month. Well, boom, I could deduct all the expenses associated with Joe's room. I could deduct if Joe's room is 20% of my apartment, then that means 20% of all the bills that my apartment have, I can go ahead and deduct. Yeah, I started my Airbnb out of my rental. Look, okay, yes, wealthing up out here. I know that's right. But yeah, so definitely if you're jumping in later on the live, then feel free to rewind this, take a look. But I did go over about 20, 25 different ways on how you can make sure that you're taking advantage of these deductions on your property. You're living there, you might as well have it work to your benefit as well and decrease their tax bill. Right. We want more money in our pocket. Okay. All right, y'all. We'll talk. I'm already a client. Yes, ma'am. Yes, ma'am. We'll talk soon. All righty, y'all. That's it. Okay. I will see y'all next week for another episode of Sipping Wealth Live. Make sure. Okay. I don't know why it's not letting me broadcast to the Sipping Wealth group. I gotta figure that out. But yes, y'all. That's it. Y'all have a wonderful, amazing rest of your Tuesday. And don't forget, let's wealth up.